Wait, stop for 1 second. Before you watch this video, I want you to do one thing. Pick up your phone, Google silver price 2011. You'll see $49 per ounce. Now Google silver price today, $28, $30, maybe $30. That means silver today is still below its 2011 peak. Gold? Gold has broken its all-time high multiple times. Bitcoin? It's done 10x, 20x, even 100x. But silver, people completely forgot about silver. And exactly that is why I'm here today telling you that silver is like a historically compressed coil that is ready to snap right now, and 99% of people are still fast asleep. In this video, I'm going to show you what financial news channels never talk about, the data that banks send only to their premium clients, the patterns that repeated in 2008 and 2011 and in 2020, and that are forming again right now. If you want to understand why silver could be a generational opportunity in 2025, stay with this video. Let's get into it. First things first, who am I and why does this analysis matter? I'm not a financial advisor. I'm not giving you investment advice. What I am giving you is data, history, and patterns. This video is purely educational. Make your own decisions. Now let's talk about silver. Silver is the world's second most important precious metal, but people underestimate it because whenever precious metals come up, everyone jumps straight to gold. That's a big mistake because silver isn't just a safe haven asset. Silver is also an industrial metal, and that is its real power. Here's what we're going to cover today. Point 1, silver's unique dual demand model. No other metal can claim this. Point 2, the gold to silver ratio, a 5,000-year-old indicator sitting at an extreme level. Point 3, industrial demand, EVs, solar, electronics, numbers that will shock you. Point 4, the supply crisis. Mines are running dry, new supply is crawling. Point 5, central banks, inflation, and dollar devaluation, what it means for silver. Point 6, historical price cycles, when silver exploded and what the pattern looked like. Point 7, today's setup, similarities with 2008 and 2020. Point 8, common mistakes, how people buy silver the wrong way. Point 9, a practical framework. If you're considering silver, here's how to think about it. This is a deep dive. Get comfortable. Let's start by understanding what silver actually is and why it exists in two completely different worlds. The precious metal side. Silver has been part of currency systems for thousands of years. The term sterling silver actually came from the fact that England's old currency was made from high-purity silver. Its cultural and financial significance goes back to ancient civilizations, from Rome to Persia to the Mughal Empire. Whenever uncertainty hits the world, war, recession, currency crisis, people run toward precious metals. Gold is the first choice, silver is the second. But because silver is more affordable, it becomes the entry point for retail investors who can't buy full ounces of gold. The industrial metal side, and this is what makes silver completely unique. Silver is the most electrically conductive metal on Earth, more than copper, more than gold. This means any application requiring perfect electrical conductivity, silver shows up. So where exactly does it get used in the modern world? Solar panels. Every single solar panel contains silver paste. One standard residential solar panel contains approximately 20 grams of silver. Now think about this. Global solar installations in 2024 were projected to exceed 400 GW. That is a massive silver demand. Electric vehicles, EVs. The average EV uses 2 to 3 times more silver than a conventional car. EV charging stations also use silver. Tesla, BYD, Ford EVs, all of them are silver consumers. Electronics, your smartphone, laptop, tablet, they all contain silver. Circuit boards, contacts, switches, all of it. Medical devices, silver's antimicrobial properties make it essential in bandages, catheters, and medical instruments. Defense and aerospace, missiles, satellites, radar systems all require high-grade silver electrical components. Here's the thing that should make you stop and think. For gold, industrial demand is approximately 10 to 15%. The rest is investment in jewelry. For silver, industrial demand is approximately 55 to 60%, and it's continuously growing. What does that mean? When the economy grows, silver demand grows. When renewable energy booms, silver demand explodes. Silver is not gold's poor cousin. Silver is a completely different animal. Now let's talk about the indicator that professional traders watch most closely when evaluating silver. It's called the gold to silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historical average? Approximately 47.1 to 55.1. Meaning, historically, gold was only 47 to 55 times more expensive than silver. Now check today's ratio. In 2024-2025, this ratio is sitting at approximately 80.1 to 90.1. That means gold is about 80 to 90 times more expensive than silver. That is historically extreme. Now let's look at what happened every time this ratio hit extremes. In 1991, the ratio approached 100.1. What followed? Silver delivered approximately a 300% return. In 2003, the ratio was above 80.1. What followed? Silver went from $4 to $49, approximately 100% return. In 2020, during the COVID crash, the ratio briefly hit 125.1, the highest in modern history. Silver then rallied from $12 to $29 in just 5 to 6 months, approximately 140% gain. Today's ratio is above 80.1 again. And people who understand this pattern think either gold needs to crash or silver needs to explode. Historical patterns suggest the higher probability is silver moving up because gold's demand drivers are completely different. Let me be clear. This ratio is not a guarantee. It's a historical indicator. Markets do what they want, but when multiple indicators align like this, you should be paying attention. Now let's get into the concrete numbers, because this section is the most important part of this entire video. The solar energy revolution. According to data from the Silver Institute, the solar industry consumed approximately 161 million ounces of silver in 2023 alone. That was a record, and global solar capacity is growing every single year. The global target? Countries around the world have committed to net zero and renewable energy targets that require massive solar buildouts through 2030 and beyond. Imagine the silver demand required to fulfill just a fraction of these commitments. The electric vehicle revolution. The International Energy Agency, IEA, forecasts over 300 million EVs on roads globally by 2030. Each EV contains approximately 25 to 50 grams of silver, significantly more than conventional vehicles. 300 million cars, x 40 grams, more 12 billion grams, more approximately 385 million ounces from EVs alone. That's more than total annual silver mining output. 5G networks. 5G infrastructure requires significant silver, antennas, base stations, circuit boards. The global 5G rollout is still ongoing in 2025, adding consistent demand. Water purification, silver-based water purification technologies are scaling across developing nations. Another steady demand driver, AI data centers. Here's a new angle that didn't exist in the 2020 analysis. AI data centers, requiring massive computing power, need silver-based cooling systems and electrical components. AI boom, silver demand. This is a demand driver no analyst predicted 5 years ago. Now the supply problem, let's flip to the supply side. Global primary silver mining is approximately 820 million ounces per year, but total demand, industrial plus investment plus jewelry, is approximately 1.1 to 1.2 billion ounces per year. These are 2023-2024 estimates. That means there is a supply deficit. Demand exceeds supply, and this gap is widening. Basic economics. When demand exceeds supply, price goes up. So why hasn't silver's price moved dramatically yet? We'll answer that next. Now let's address the elephant in the room. If silver's fundamentals are this strong, why hasn't the price moved? The honest answer is complex. I'll give you the clearest version. Paper silver. Silver isn't just traded as physical bars. There is a massive paper market, the COMEX Futures Exchange. On COMEX, billions of dollars in silver contracts trade every single day. But, and this is the key, most of these contracts have no actual physical silver behind them. Estimates suggest the paper silver market is approximately 200 to 300 times larger than the physical silver market. That means for every ounce of physical silver, there are 200 to 300 paper claims on that silver. When price starts rising, large institutions dump massive sell orders into this paper market, artificially suppressing price. This is not conspiracy theory. It's documented. In 2020, Deutsche Bank paid a $60 million settlement on silver manipulation charges. JP Morgan traders were convicted in 2022 for spoofing, which is essentially market manipulation. I'm not saying silver is uniquely victimized. Manipulation exists in stocks, currencies, and commodities. It's a known market reality. But here's the thing. Manipulation cannot last forever. Fundamentals always win in the long run. When physical demand overwhelms the paper supply to the point where the system cracks, a price reset occurs, and many analysts argue we are getting closer to that point. Dollar devaluation. Another factor, the US dollar and global currencies. When currency weakens, commodities, especially precious metals, appreciate. US national debt crossed $34 trillion in 2024. The Federal Reserve printed massive amounts of money in 2020-2022, which everyone felt as inflation. Inflation means currency's purchasing power is falling, and when currency falls, real assets gain value. Silver is a real asset. Its production is limited, you can't print it. Let's go back in time, because silver cycles are fascinating. The 1970-1980 cycle. In 1970, silver was approximately $1.50 per ounce. By 1980, silver hit $50 per ounce. Approximately 3,200% return in 10 years. Why did this happen? Vietnam War, oil crisis, high inflation, the dollar leaving the gold standard, all of it rocket-boosted precious metals. The 2001-2011 cycle. In 2001, silver was approximately $4 per ounce. Through the dot-com bust, 9/11, the Iraq War, and the 2008 financial crisis, silver slowly climbed. By 2011, silver hit $49 per ounce, approximately 1,100% return in 10 years. Then what? The Fed raised rates, inflation cooled, the dollar strengthened. Silver crashed from $49 to $14 by 2015. 2015-2020, silver ranged between 14-18s, going nowhere. Then COVID hit, silver briefly dropped to $12. Then massive stimulus, money printing, recession fears, silver went from $12 to $29 in 5 months, 140% plus in months. Today's picture, silver is in the $26 to $30 range, depending on when you're watching this. But the fundamentals, industrial demand, supply deficit, gold to silver ratio, dollar weakness, look remarkably similar to the 2001-2003 setup. So if history rhymes, where could silver go? Nobody gives you a guaranteed number because markets are unpredictable. But here's what analysts are discussing based on different scenarios. Conservative scenario, $50, $60 if gold stays near all-time highs. Moderate scenario, $75, $100 if industrial demand keeps accelerating. Aggressive scenario, $150 plus if a dollar crisis or major supply disruption hits. These are projections, not guarantees, but they help you understand the potential upside. Now let's come to 2025, because this is where everything converges. Factor 1. Federal Reserve policy shift. In 2022-2023, the Fed aggressively hiked interest rates. That was bearish for precious metals, because high rates mean a stronger dollar, which means weaker metals. But in 2024, the Fed started cutting rates, and in 2025, that cycle is continuing. Rate cuts are weaker dollar, are stronger precious metals. This is a macro tailwind directly benefiting silver. Factor 2. Gold is already breaking out. Gold broke through $2,000 in 2024, then $2,500, new all-time highs. Historically, when gold moves strongly, silver first underperforms, then suddenly, sharply outperforms. This catch-up move is historically violent and fast. And right now, gold has already made its move. Silver hasn't caught up yet. Factor 3, central bank buying central banks, China, Russia, India, Poland, Turkey, are buying record amounts of gold. This is a reserve diversification strategy, reducing dollar dependence. This behavior reflects inflation expectations and dollar distrust. And whatever pushes gold also pushes silver. Factor 4, geopolitical uncertainty. Russia-Ukraine ongoing. Middle East tensions escalating. Taiwan-China tensions simmering. Post-election global uncertainty. Geopolitical instability has always driven capital into safe havens. Precious metals are among the most classic safe havens in history. Factor 5, the AI plus green energy double whammy. In 2025, both themes are accelerating simultaneously. AI infrastructure build-out and the green energy transition. Both sectors use significant amounts of silver industrially, and both sectors are attracting massive capital investment. This is a unique double tailwind that has never existed at the same time before. Factor 6, silver ETF inflows. Institutional investors are showing interest in silver. Track silver ETF inflows. This is a real-time indicator of where smart money is moving. When institutions start accumulating, retail usually follows. Now let's talk about the common mistakes people make when considering silver, because this is just as important as the opportunity itself. Mistake number 1, going all in on silver. You should never put everything into a single asset. Silver is a speculative bet. This does not mean putting your entire savings into it. In a well-structured financial plan, silver could be a component, perhaps 5% to 15% of a portfolio, but this is personal and depends entirely on your situation, risk tolerance, and goals. Mistake number 2, treating paper silver as real silver. If you're buying a silver ETF, you're buying paper exposure. You don't physically own silver. Paper silver has its own advantages, liquidity, convenience, no storage headaches. But if someone wants true physical ownership as protection, physical metal is necessary. Mistake number 3, short-term mindset. Silver is extremely volatile. A 10 to 20% correction can happen at any time for any reason. If you're expecting a 2x in 3 months, that is the wrong mindset. Historical cycles play out over 5 to 10 years. Anything can happen short-term. Mistake number 4, ignoring the premium on physical silver. Whenever silver demand spikes, dealers charge a premium above spot price. You could end up paying 10 to 20% above spot when you buy physical silver. Factor this premium into all your calculations. Mistake number 5, using leverage. Some people trade silver futures or leveraged products. Silver's high volatility combined with leverage is a recipe for disaster. If price moves even slightly in the wrong direction, an account can get wiped out. Mistake number 6, ignoring storage costs. Physical silver is heavy and requires secure storage. A bank locker, home safe, insurance. These costs need to be factored in. Mistake number 7, not understanding tax implications. Gains from silver are taxable. The rates and rules vary by country. Always consult your tax advisor before making significant moves. If someone is seriously considering silver, here is a framework that might be helpful. Step 1, define silver's role in your portfolio. Silver is a hedge, an inflation hedge, a currency hedge, an economic uncertainty hedge, and simultaneously, it's an industrial growth play. It is not a substitute for stocks and bonds. It is a complementary asset class. Step 2, physical versus paper versus mining stocks. Physical silver, coins, bars, direct ownership. You'll pay a premium, need storage, and liquidity is lower. Silver ETFs, widely available in most markets. Convenient, liquid, but paper exposure, no physical silver. Silver mining stocks, high beta play. If silver rises, mining stocks typically move 3-4x silver's percentage gain. But company-specific risks, management, geopolitics, mine quality, add layers of risk. Step 3, dollar cost averaging, DCA. Don't put it all in at once. Systematic investment, a fixed amount every month, reduces the risk of bad timing. Step 4, be clear about your time horizon. Think with a minimum 3 to 5 year horizon. Silver is not a get-rich-quick scheme. Step 5, have an exit strategy before you enter. When will you sell? Rough framework. If gold-silver ratio approaches 40, if silver reaches 60 plus, if economic uncertainty resolves, decide in advance. Don't make decisions in the heat of emotion. Step 6, get professional advice. This video is education, not financial advice. Consult a registered financial advisor for your specific situation. Step back even further. Think about the big picture. What is happening in the world in 2025? De-dollarization, BRICS nations, Brazil, Russia, India, China, South Africa are actively challenging dollar dominance. Saudi Arabia is now conducting some oil trades in non-dollar currencies. This is a slow process, but the direction is unmistakable. When dollar hegemony weakens, alternative stores of value, gold, silver, appreciate. The debt crisis. Multiple countries, including developed ones, are carrying unsustainable debt levels. Japan, USA, UK all have massive debt to GDP ratios. This ultimately resolves through monetary debasement, inflation, and inflation is historically bullish for precious metals. Green energy transition, the Paris Agreement, net zero targets. These are political commitments driving massive capital allocation. Solar, wind, EVs, all of them run on silver. This demand is not artificial. It is policy-driven structural demand that will persist for decades. The AI arms race. The US and China are investing trillions in artificial intelligence. AI infrastructure, you data centers, you servers, you chips, you silver. This is a brand new demand driver that no analyst predicted a decade ago. Inflation stickiness. The inflation that came after COVID was not transitory. No, it was structural. Food prices, energy prices, housing costs, all structurally higher. Central banks are struggling to cut rates without reigniting inflation. This environment is historically bullish for precious metals. A lot of people ask, is silver better than gold? Is silver better than Bitcoin? Is silver better than stocks? Honest answer, that is the wrong question. Different assets serve different roles, but the comparison is useful for understanding. Silver versus gold. Gold is more stable, silver is more volatile, gold is a pure monetary metal, silver is monetary plus. Industrial, silver is more affordable for retail investors. In bull cycles, silver typically outperforms gold in percentage terms. In bear cycles, silver underperforms gold. Silver versus Bitcoin. Bitcoin has a hard-capped supply, 21 million coins. Silver has no infinite supply, but new mining faces increasing challenges. Bitcoin is purely speculative monetary. Silver has an industrial demand floor. Silver is less volatile than Bitcoin. Bitcoin is more liquid than physical silver. These are two completely different risk profiles. Silver versus stocks. Stocks, over the long term, are typically the best performing asset class, but stocks are correlated with the economy. Silver is sometimes negatively correlated with crisis. When everything falls, silver can hold or rise. Silver is a diversification tool, not a primary growth engine. Silver versus real estate. Real estate is illiquid. Silver is relatively liquid. Real estate generates income, rent. Silver does not, no yield. Silver is portable. Real estate is not. The point is, no single asset class manages your entire financial life. Silver is one piece of a larger puzzle. A quick real-time check. The signals visible in 2025. Signal 1, gold has broken multiple all-time highs. Historically, this is a leading indicator for silver. Signal 2, the U.S. Federal Reserve rate cut cycle has officially begun. Signal 3, global silver imports have significantly increased. Physical demand is strong. Signal 4, major silver mines in Peru, Mexico, Australia are facing production challenges. Political instability, labor strikes, declining ore grades. Signal 5, silver ETF inflows are positive globally. Signal 6, industrial demand projections, solar, EV, AI, are all being revised upward. Signal 7, the gold to silver ratio is historically elevated. Every single time it hit these extremes, silver caught up. This is not a perfect storm. Markets are never perfect, but this is a historically compelling setup. I want to leave you with one thought. I remember 2920, when COVID crashed everything. Silver dropped to $12. A lot of people panicked. They sold. And then, 5 months later, it was at 29. The people who understood the asset stayed committed and held through the noise. They saw extraordinary returns. But those who panic sold, they only got the loss. With silver, timing is uncertain. When it explodes, nobody knows. Maybe in the next 6 months, maybe in 2 years. But the point of this video was to help you understand why silver is interesting, to understand the fundamentals. If these fundamentals are convincing to you, do your own research, talk to your advisor, make a decision within your own capacity. And if they're not convincing, that's completely fine. Every asset is not for every person. What matters is that you stay informed, that you understand where your money goes and why. That's why this channel exists. If this video was helpful to you, please hit like. Seriously, it makes an enormous difference for the YouTube algorithm. If you want this kind of analysis regularly, hit subscribe. I put out one in-depth video every week. Drop a comment. Do you invest in silver already? Have you ever considered it? I read every single comment. And one request: share this video with friends and family who are serious about money and investing. Awareness is the first step. The next video is going to be gold versus silver. Which should you buy in 2025? Hit the notification bell or you'll miss it. Until then, stay smart, stay informed. See you in the next one.